Hedge funds are selling, retail traders are selling. It literally feels like everybody is selling their stocks right now. I mean, look at the fear greed index. We're literally at a reading of 4. 4 is the lowest level that I've ever seen in my entire life. Year to date, all the major indexes are getting totally wiped out right now. The Nasdaq is down 18% year to date, and the S&P 500 is down 15% year to date. But there's one massive silver lining that nobody's talking about on YouTube, X, Instagram. I don't see anybody talking about this. I'm going to show you that chart in just a second that breaks down why this could potentially be one of the best dip buying opportunities that we're going to see in many years. So let's go back to the charts just to see what's really going on. So this is the S&P 500 tracked by VOO. It's one of my favorite ways to get exposure to the S&P 500. So you can see year to date we're down 15%. On a 1-year basis we're down 4%. But look at what happens when we flip to a 5-year basis right here. We are still up 78%. And that doesn't even include the dividends that you get to be reinvested. So you're going to be up a little bit more than this. So the point that I'm trying to get at is this. When you look at a chart like this, it looks really bad. When you look at a chart like this, it looks okay. But when you look at a chart like this, it kind of looks pretty good. Yes, this is a pretty big dip right here, but look at the progress that we've made since 2010. We went from $100 a share to $456 per share. Now, I'm definitely not saying to just go buy the dip, because that would be crazy if you go buy the dip and you don't understand everything I'm going to present to you in this video. But by the time we get to the end, you might want to go do just that. You might want to just go buy the dip, because there's a really interesting stat that I just came across today that I'm going to show you that I've never showed this before to anybody else. So we'll get there in just a second. Now, going back to the NASDAQ, you could see on a year-to-date basis down 18%, 1 year down 5%, and 5 year, it's 107%. So typically the stock market's going to average 10 to 12% per year. And the NASDAQ, you could assume, at least I'm going to assume, that it's going to do a little bit better going forward from right now, because I am expecting better growth out of the NASDAQ than the S&P 500. So yes, on a 5-year chart, it looks very bumpy, but look where you started. $200 a share in 2020, $416 right now. You made a lot of money right there. What if we zoom out even more? The trend becomes very crystal clear. Even if you bought in at the peak of the market right before the dot-com crash, you were buying in for $100 a share, and all you had to do is be patient and you would be at $416 per share. I get it that that was 25 years ago, but if you have a clue, a random clue about the market to understand the valuation level, anybody with a random hint of valuation would have not bought the market in this valuation level right here. And I would have been absolutely screaming at you guys if you were trying to buy in at the top of the market right here, because it was crystal clear that the market was extremely overvalued. The companies back then were not actually making money. Anything with a .com behind a name was just going straight up in price. Yes, we had a euphoric rally right here coming out of 2022, but the companies are truly making a lot of money. Yes, we did get a little bit detached up here and the market went up a little bit too much, which we're going to get to that in just a second. I'm going to show you that one chart that's really going to change everything. But the companies right now are truly making a lot of money. Now, to cover a little bit on valuation, we're going to go back to this chart that just got updated today. I'm going to show you this chart in pretty much every video, because this is hands down one of the most important charts that you could look at with regards to valuing the stock market. So right now, the forward PE ratio of the S&P 500 is sitting here at 18. We were all the way up here at 22, but the market went pretty much straight down. So that means the PE ratio is going to go down too, assuming that earnings hold up on this side of the equation right here, which I do think that earnings for the most part are going to hold up relatively well. I think it's going to be better than what you think, and I'm going to tell you about that in just a second. Now, we came down to this level right here. Are we still a little bit overvalued? Well, look, going all the way back to 1985. We were all the way down here at roughly 9 for the PE ratio, because nobody wanted to put their money in the stock market, because bonds were yielding roughly 15 to 20% in that time period back then. So there was no reason to put your money in the stock market, because this was considered to be risky, but the bonds were considered to be guaranteed. As bond yields started to fall, stock market PE ratios went up, because stocks became more attractive and bond yields were going down. So it's like nobody wanted to put their money in a bond. It wasn't worth your time. Now, the point that I'm trying to get at is this. We went way up into 1999 up to 2025. Going into the 2008 financial crisis, we went all the way back down to 9, and then we pumped all the way back on this recent rally right here, all the way up to like 23, which you could see is historically high on top to top to top. Now that we're down at 18, we're at a more reasonable level, but we still are a little bit elevated. And the reason that I know that we're elevated is by going to the next chart right here. We got to look at the 10-year bond. because if the 10-year bond is going up in price, this is going to become more compelling because you could get a guaranteed 4.38% return on your money. Versus the stock market with all this turbulence right now, people are getting nervous and they just go buy the bond. But something very, very interesting is actually happening right now, and I don't think many people are really talking about this. So let me flip this to a 5-day chart right here because this is something that not a lot of people really understand in the market, and this is why there might be more trouble ahead in the near term for stocks, but in the long term, this could be one of the best dip buying opportunities that you're probably ever going to get. So going to a 5-day chart, we're here. You can see that the 10-year bond was yielding roughly 3.89%. Now we're at 4.38%. So we had a massive rally in bond yields right here because people were selling their actual bonds itself. Let's just use my Expo pen as an example because it's always sitting right here on my desk. If people are selling this, that means there's not a lot of demand for it, which means that the price of this Expo marker is going to go down. When the price of the Expo marker goes down, the yield on it, which is the yield right here of 4.38%, the yield is pretty much going to go straight up because the market always wants to find that equilibrium of what the true value of something is. So as the yield goes up, it's going to drive more demand for people to go buy the 10-year bond. And the rumor behind this, why the 10-year bond is actually going up in price, is because China is apparently selling 10-year bonds because we just retaliated on them with a bunch of tariffs and they retaliated back. And at the time of recording this, tariffs are over 100% on Chinese imports into America. And it's actually working very, very well for China to put pressure on the United States economy because as they dump our bonds, as they sell our bonds, like I said, the bond yields are going up. As bond yields go up in an economy that's going down, it's a very tricky situation to try to stabilize your economy because in theory, you want your bond yields to go down, which means interest rates go down. If interest rates go down, people are going to be more willing to go borrow money. When you go borrow more money, it's good for the economy. But as these yields are going up and the economy is going down a little bit, it's putting double pressure on the economy to just be in a bad place. So Jerome Powell at the Federal Reserve, he has to make a decision. He has to say, do I save the labor market? Do I save the economy? Or do I try to keep inflation down? I think I know exactly what he's going to do, and this is why I think the stock market's going to rebound really, really sharply pretty soon. I'll go into that in just a second. So now that we got the negative stuff out of the way, we talked about how Jerome Powell's in a tough position. We talked about how bond yields are going up, and we talked about how the stock market still, in my opinion, is a little bit overvalued. Even though we got this big dip recently, I still think the market's a little bit overvalued. I want to flip to the optimistic side of things. I'm going to try to make a case to you guys right now as to why I think the stock market could pretty much go straight up, and all we need is one thing to happen. So I'm going to go through a couple charts right now just to try to get you in the right mindset for this, and then I'm going to present the information to you. So I want to cover this chart right here, the S&P 500, super quick, and the left side starts at 2009, and the right side goes to 2017. Look at all these news articles right here that's going on in the market. Look at all this stuff going on in the economy that's really bad. We had stocks falling 20%, downgrade of U.S. debt, government shutdown. We had a temper tantrum. We had Ebola. We had Brexit. We had a bunch of stuff happening in the stock market where everybody felt like this was the worst possible scenario and we're never going to be able to recover from this. But look at what happened. Look at the gain that happened in this time period right here, 271%. All you had to do was buy right here and forget about all these negative news articles that came out, and you could have just woke up in July of 2017 and saw that you made 271% on your money. This chart actually cracked me up once I started reading through all these headlines right here. Look at what this Robert guy right here said. 50% unemployment, 90% stock market crash, 100% annual inflation as soon as 2012. This is right here on the bottom of the market after it took this little dip right here. Look at Mark Faber right here. Prepare for massive market meltdown. Look at this guy right here. Predicts a 60% stock market collapse in the next 3 months. The next crash will happen by year end. Stocks will go 20% lower. 1929 parallel warns of a crash. This is preordained. Notice that every single one of these negative news article headlines came out when the market was dipping. There's not much coming out on the top of the market right here. They all come out on this little bit of volatility that's happening in a market. And here's another one that I put in my most recent newsletter that I send out every Sunday. If you want to get it, click the link below. You can sign up. It's 100% free. I just email it to you every Sunday. I break down what's going on in the market, the important stuff. So this goes from 1936 on the left side all the way to 2021 on the right side. Look at all this crazy stuff that happened through here. I'm not going to read everything to you, but we had JFK get assassinated. We had a Cuban Missile Crisis. We had World War II crash. We had World War II starting. We had Oklahoma City bombing. We had the swine flu. We had an Ebola temper tantrum. We had a trade war. We had COVID-19. We had a lot of bad stuff happening in the stock market in this whole time frame right here. But what did the green line do? Let's trace it all the way up and to the right. A lot of volatility along the way, a lot of gray lines right here for recessions. But what did the market do in the long run? Did it go up and to the right or did it go down? The market kept going up in the long run. And you're probably saying right now, I get it, Brandon. I understand that if I just zoom out and I look at the market on a long-term basis, I'm going to be okay. So what do we do right now? What do we do to capitalize on this market dip? Are we going to go lower? Are we going to go higher? What do we do? So now I'm going to show you the next couple charts that really changes everything. Why I think that the market is close to a bottom. I'm not calling a perfect bottom right now because nobody on planet Earth knows that. But I do think the more that we fall, the cheaper that we get, and the better the opportunity is going to be. So let's flip over to the chart right here. So there's a lot of numbers going on right here, but let me just simplify it for you. So today we close on the VIX index, which is a volatility index. It's basically just saying as the volatility goes up, the market's going to be bouncing around a lot more. So we close at a very high volatility level today at 52.33, which is highlighted blue right here. So this ranks as 70th as closing at the highest volatility going all the way back to 1990. Now look at the clear trend that you could see right here. Now you could obviously see that everything is green right here. And on Twitter, I said, check out the chart below, which shows you the S&P 500 gains for the next 1, 2, 3, 4, and 5 years. All years posted above average returns. Be patient, guys. So look at these 1-year returns just on average. Typically double-digit returns for 1 year, double for 2, double for 3, double for 4, double for 5. You get it. The point that I'm trying to get at is this. There's a crap ton of fear in the market right now. It's kind of zoomed in, but you could see it's 4 right there. There's a crap ton of fear in the market, and this is when people are freaking out. And there's a statistic that if you miss the 10 best days in the market, 10 days out of the last 30 years, your return will be cut in half. Because when there's a lot of volatility in the market is going up and down, sometimes 10% in a single day. You need to be invested in times like that because it's very, very hard to know when the market's going to go up 10%. All it takes is Trump to make a single trade deal with a big country like China, and the stock market will go completely vertical. It's probably going to go 10% in one day up, maybe 5% the next day and 5% the next day. Maybe not that fast, but the market will go pretty much straight up. And if you're sitting there on the sidelines, it's probably going to happen before you even know it, and you missed out on a huge part of your upside right there. A lot of the massive stock market returns actually happen in a bear market, which we technically are in a bear market right now, because stocks are bouncing around like crazy. So understand that time in the market is way more important than timing the market. And before you're thinking about selling, go back and look at this chart right here and understand that when we're closing at a VIX of 52, the market is bouncing around like crazy. And if any good news comes out, the market is very easily going to go straight up. And I talk about this thing in my course all the time, which is the rubber band analogy, where basically the slower the dip takes to go down, the longer it takes to go back up. But when you have very sharp volatility like this example right here, like straight down and straight up, usually the market goes straight down and straight up. So the faster it goes down, the faster it usually rebounds up. And you could see we are pretty much straight down right now. I'm not saying we're going to go straight up and this is going to be a V-shaped recovery like this, but it's very, very possible. We're like stretching that rubber band down of the stock market, and there's becoming tension down on the market right now. And if we get any hint of good news, the market's going to go ping and go straight up. I'm not saying we're going to get good news, but if we do get good news, I promise you the market will go straight up. And you don't want to be uninvested on days like that. Going back to the PE ratio, yes, we're still a little bit expensive, but if their earnings growth continues to keep up and interest rates go down, this will be justified at an 18 level right here. The moral of the story, nobody knows exactly where the bottom's going to be. You just want to know when it's a pretty good buy and it's a pretty good sell. Other than that, don't try to be perfect in a stock market, because if you're a long-term investor, you don't have to be perfect. The longer that you hold, the more money that you're probably going to make. Only use stock options on ultra high confidence plays. If you don't know how to do the valuation stuff, if you don't really know how the market actually works, click the link below, do my course. It's $97. It's going to 100% change your life on everything with the stock market. You're going to learn everything about how this stuff actually works. If you don't want to do my course, watch the video right here. It's how I do stock options on a very basic level. I'll see you guys there.